Welcome to Trader TV, your insight into trading for professional investors. I'm Dan Barnes. Markets are in turmoil and asset managers under enormous performance pressure. We're asking Gianluca Minieri, Deputy Global Head of Trading at Amundi Asset Management, how buy-side trading desks can be designed to handle high volumes of orders across asset classes within margin-constrained businesses. Gianluca, welcome back to Trader TV.
Hi Dan, thanks for having me again.
How would you describe market conditions today for traders?
If we look at the trading blotter today,
Yep.
you will see something completely different of what you would see last week. The reality is there is no liquidity and prices are everywhere. Okay, so what does this tell you? It tells you that most of the time liquidity is there when you don't need it.
Yes.
Efficiency means that when a client gives to us the mandate of managing his order, what we can offer to him is to be in the hands of someone that has the strength, the infrastructure, the organization, the power, the means to run a complex machine, but at the end of the day can give you what we're looking for. So liquidity at good prices.
What sort of pressures are buy-side firms under at the moment to restructure their trading operations?
The buy-side dealing function is currently facing a number of challenges that are going to be the catalyst for a profound restructure of this type of function. The first one would be cost. According to a very recent research that I've read, the cost of a buy-side trader to the company, the cost to the company might end up to be approximately 350,000 euro. So that means that a small trading desk of 3 people, which is the minimum setup, might cost up to €1 million. And this is a small trading desk that will have a limited capability in terms of cross-asset trading and time zone. The second one would be regulation, because since the crisis of 2008, financial markets have been impacted by a number of very large pieces of legislation. So there has been a significant increase in the regulatory burden of companies. So trading has become pretty much a risky and demanding business to run. The third one, probably the most discussed over the last few years, has been technology.
So what might buy-side firms do to restructure their operations?
So the first thing is automation.
Yeah.
This will allow us to free up time for our traders to dedicate to activities where they can really add value to the investment process. The second one is a change of model. Up to a few years ago, our traders were divided into asset classes. So you had the typical fixed income trader, the equity trader, the derivatives trader, and so on. But technology and electronic trading have led some instruments to be traded in a similar way. So the way we are reorganizing our teams today are based more on liquidity clusters rather than by instruments. It is a reality that today, if you don't have a global integrated infrastructure capable of managing all of your orders from inception to completion, liquidity is a loser game.
Yeah.
The market is now mature for outsourcing trading. 20% of buy side in the next 5 years will look to cut cost, and they will include trading in their synergies. This means that they will look for other people that can execute the orders on their behalf.
What are the complexities?
The complexity probably is on the service providing side.
Right.
Today, it's quite easy, to outsource your trading. All you need is a connectivity. Mm-hmm. So we feel that the complexity will be ensuring that your orders will be treated fairly together with our orders. You need to ensure that your trading protocols are safe, your trading protocols are secure, and that the client is confident that the overall process, the overall governance of this process is safe.
As far as the liquidity profile model for trading goes and the increased automation, what sort of complexities have you faced there?
When you have powerful machine, you will need people that are able to maneuver that machine. Just to give you an analogy, I think that when you drive a racing car, you need to be even more skillful than if you drive a normal car.
How are you addressing those complexities internally?
We are 100% focused in building the trading organization of the future. So the challenge for us is to think a little bit out of the box. I think the next stage will be how to unlock, the huge amount of frozen bond and stock inventory that the buy side have.
So you see internal efficiency providing that liquidity and the fluid trading?
Absolutely. One thing we put a lot of emphasis on is the relationship with our counterparties.
Yeah.
We like to work with counterparties with which we can build a trusted long-term business relationship.
Yeah.
So it is this type of counterparty network that is key in a moment like this to be able to step in the market and find liquidity. This counterparty knows that, if they don't provide to us liquidity now, they will probably not worth working with them in the future. This type of business relationship are much more difficult for small and medium players in the market.
Gianluca, thank you. That's been fantastic.
I hope that when everything will be finished with this virus, I'll be able to be there in the studio again.
Absolutely, me too. Thank you very much.
Thank you.
I'd like to thank Gianluca Minieri for his insights into multi-asset trading, and of course you for watching. To catch our monthly reports on other markets or to subscribe to our newsletter, go to tradingtv.net and etftv.net.